Hi and welcome to this new video where we will review some positions for the long volatility strategy on earnings that we usually discuss. So we will look at how we calibrate different positions for the strategies, review their targets, and especially focus on how to exit them, basically how to set up a way so that we are prepared to what will happen and do not face basically emotionally having to react, and so doing this research and preparation beforehand. And so today we'll take an example of Morgan Stanley with its earnings last week and discuss in detail how these different positions worked out and how we handled basically their calibration and exit. So let's dive right in, and let's start by reviewing some of the signals of why Morgan Stanley was a good candidate for this long volatility strategies. As you know, long volatility in a nutshell is the bet that the move on the day of release, the first day of trading after the earnings is released, the actual stock move will be higher than the move priced in by the implied move, basically. These imply non-directional positions, so not just buying calls or puts, but actually both, and arriving at these positions where we basically bet that the actual volatility will be higher than what's priced in. And so for this, an important step is to benchmark the current implied, the implied before earnings, to what actually happened in terms of past moves, so we can get an idea of how undervalued or overvalued and favorable basically the setup is. For Morgan Stanley here, so we see our moves analyzer from the Earnings Watcher platform showing a recap of the past earnings moves. We are interested in obviously this column here in this table, so let's discard the last line of the earnings last week that we're interested in. But so before that point, this is the move on the day of release for the past earnings. So, and we notice these somewhat big amplitudes, minus 5.5, 8.6, 7.2. And what looks like a volatile stock overall with these big moves. The lowest moves over the last 2 years seems to be this 1.5%. And so when we looked at how the implied move last week, basically leading to earnings, was looking before for Morgan Stanley, we noticed that it was priced around plus minus 4%. So here you see in this histogram, this really is basically a graph that shows the distribution, if you like, the frequency of the moves that happened, that we see in this column here. The x-axis shows the value of the move, and the y-axis shows its count, basically. So we can see what are the most frequent moves in terms of this distribution. We plot here the plus minus 4% threshold that is currently priced in, and so we see that indeed it does encapsulate basically a lot of the frequent moves, since it's we see that the most frequent move over the last 10 years, as we see here, is the 1%, basically plus minus 1%, expected if we look at this big sample of data. However, we also notice actually good signals for us, which are these somewhat fat tails where the distribution does not seem very Gaussian, as you can see. We notice these somewhat high occurrences of values over that threshold of plus minus 4%. And so this was a good signal that perhaps the implied move was somewhat undervalued, and looking at the average moves and the different statistics about these past moves, actually that plus minus 4% has a good likelihood of being beaten. And so the idea, as you know, is to set up positions that have a favorable risk reward, basically to take advantage of this favorable setup that was looking before Morgan Stanley earnings. So what we did last week was, as usual, we go ahead and start and calibrate some positions. The classic position for the long volatility strategy, as you know, is what we call the straddle, so the closest expiration straddle. Here you see, by the way, the simulator from the Earnings Watcher platform. This is really an option pricing simulator with the specificity that it takes into account the IV crush that happens on earnings. And so we see this position of the classic straddle, as I noted, 87 call and this strike and 87 strike on the put, costing around $4.1 per contract. This was around close on the 15th, basically, since the earnings is for the 16th. It was on Tuesday, sorry. So we were doing this calibration beforehand. I usually on Monday, a day before. So around close, a day before earnings for Morgan Stanley, we see this current straddle, as I mentioned, 4.1 price, very low delta as expected from this non-directional position, and especially this IV behavior that currently was at 50.4%, that will drop to 31. Concretely, this really means that the thing to keep in mind when looking at this position is the very important metric, the number of the break even. As you see here in more detail, it is quite centered, plus minus 4.2%, meaning that this is the amount of move that is priced in because of this IV crush that will happen, and also because of theta decay. And so looking at the straddle, we would see that, okay, this is our break even as expected from when we did our first analysis. And also this allows us to have a sort of realistic range of scenarios, what could happen on Morgan Stanley earnings. And so for this, we use this analysis we did on the past moves, and we notice that, okay, a worst case scenario, let's say it looks like a 0% move, let's be even more extreme. A good move seems around this 7%, 8% that we've seen historically occur quite often actually in the last 2 years. And so this allows us to now actually set targets for our position. Notice how using these sliders we can now test different stock move scenarios and see how our position will react. We obviously are interested in doing that for these realistic ranges we found, so the minimum move 0% and sort of the maximum move plus minus 8%. We see that our position for this closest expiration straddle, sort of the classic position for long volatility, will basically we are facing a loss of either 30% or a profit of 50%. These are the extreme scenarios of either 0% move or plus minus 8% move. These are very important numbers to keep in mind, because if we choose such a position, we need to be comfortable with these numbers basically. So if we are not comfortable going to that 30% loss, as we see is the worst case scenario here. Notice how, by the way, in this picture here, we are simulating a move of 3.6% on Tuesday. Substantial, but somewhat still lower than our break even, and so we see that our loss will be reduced to 10% basically from the extreme loss of 30% if there is no stock move. And again, for 8% move we would be looking at 50%. So these are the targets that this position come with. If we're not comfortable with this, whether we want more return or less risk, we can calibrate accordingly. And so a classic, for example, more conservative, less risky position, let's say, for the same approach is also a straddle, but now using a further expiration. So not the closest one of April 19th, but actually here going even a month further with May 17th expiration. Quickly, we notice how the break-even got a little bit higher. Obviously, this is a price to pay, as expected, from optimizing this risk-reward. The position is a bit more expensive with $6 per contract. But again, now our max loss is reduced, and so our profile and our new target seem more around minus 20% to plus 40%, basically. And so, if we're not comfortable with the first type of positions, there are ways to improve and lower our risk. Obviously, we see that we also lower our reward. And so we arrive, for example, with this further expiration straddle at this minus 20 to plus 40%. Again, based on these realistic ranges of 0 to or plus minus 8% move. But keep in mind that we can reduce even further this risk and use positions like inverse condors, for example, and things like that, and get even lower targets if one is comfortable with really low risk. However, there is also the approach of being actually very risky and wanting to sort of have a big return and being comfortable losing more of the position. Here we see a strangle now, so this is also closest expiration, but now the strikes are out of the money, so as you expect, this position is riskier. Notice how, first of all, is way cheaper. Now it's only 86 cents per contract versus the other $4, $5 amount we've seen. The break even also a bit higher than the closest expiration straddle. Keep in mind that, by the way, the closest expiration straddle usually always has the sort of lowest or classic default implied move to benchmark against. This is why we started by looking at that implied move when we did our moves analysis. So 5%, a bit higher, but still playable. And especially we notice now that the returns and the targets differs a lot, where the loss is now potentially a 60%. The return is also quite higher at around 100%, again, for these realistic ranges of 0 to or plus minus 8% move. Notice how for the loss does not get reduced by a lot, even if there is a stock move. Here the picture is simulating still a 3% move, and we see that our loss, 47%, lower than this maximum loss of absolutely no stock move at all, as we see, but still got reduced, but not by that much. Okay, so this is also a classic of strangles, where really it's a make or break scenario, where either the implied is beaten and then we can make big profits, or even if it does not get beaten and even if it gets very close to that threshold, we will be losing. Okay, and so now that we have our three classic strategy positions, let's take a look at what actually happened on the day of earnings for Morgan Stanley. Basically, the stock opened at 3%, so this was lower than our implied moves across all the positions. However, it did grow and reach around 5% by the afternoon, and the next days kept going higher, reaching maximum around 6% basically by the end of the week. So this is an interesting case to review. Okay, now how do we exit or how do we basically apply our calibration and our preparation? And now we will see that once we've done these targets basically and done the research to benchmark against realistic moves, etc., the exit approach is actually quite straightforward. So let's take the first scenario where we say we are very conservative, and let's look as usual at the classic straddle, closest expiration straddle, 87 call and put. And so remember, this was a target position with a minus 30% to plus 50% basically PNLs or expected returns. Now, once we've seen the market open and the stock being at 3%, obviously lower than our break even. And so one approach would be to, if we are very conservative, we see that the loss currently at open with only that 3% being at 10%, it's actually lower than, our maximum risk that we planned, that 30%. So a conservative exit will be, okay, take that loss right away, basically stop the loss, and if we were happy to take that 30%, we can be very binary in our approach. Either the big move happened by open or not. If it didn't happen, well, we take the loss right away, and so hopefully it is reduced because, as we see, it was lower than the one we were ready for, basically. If the stock opened at 0%, we would have been ready for that 30% loss and also would have taken it. Here, for a conservative person, well, seeing that the loss is lower than expected, it can be taken right away, and so minimizing basically the loss here to basically move on, go ahead to the next trade, which is a very sound approach. However, the normal approach, since usually if we have taken that 30% risk, or if we taken that position with a 30% risk, we should be more comfortable to go to that level of 30% actually loss before exiting the position. So at open, even if the move was not enough, so our loss was reduced to at only 10%, it was above our max risk. So a normal exit will be to hold until we hit that threshold, basically. And from our calibration, we've seen that that threshold is either hit with a 0% move, basically at open, or it will be hit during the day, during the morning or the afternoon, as theta decay plays also a role in eating away at our position. So either we basically, we are really expecting these outcomes, and so we are comfortable holding to 30%. And so here we see the second type of exit, which we will call a normal exit, given the calibration of the position. Well, the stock opened at 3%, so minus 10% loss. We hold because we are comfortable. We are willing to go to that 30%. And so what ended up happening is that the stock moved slowly through the day, actually through the morning, to reach 4.5% and even 5%. And so now we ended up having a profitable position where now our P&L was at 10%, where basically the move broke our implied move and the thesis was correct. And so the normal exit will be, okay, now that we are profitable, we are not at our target of that, remember, 50%, which is the really best case scenario of a huge move or big move, more realistically, that will happen on open. Here we see that it slowly grew from 3 to 4.5, and so the normal exit will be, since we've seen this profitability and this good return, well, we will take it now that since it is profitable, it is green, and we didn't have to go over our max risk basically of that 30% that we see here basically in the thresholded line. If we did not exit at that level, at that 10%, well, the position would have went down and lost because of theta decay, as we mentioned. And so by end of the day, we would have broken our max risk of that 30%, and we would have exited by then. This is the importance of sort of setting these targets, and so actually monitoring for the expected scenarios, and being very important, being ready basically to either go to that max risk of 30% or skip the position and go with a lower risk position if that number is not comfortable enough for us. Now, the other scenario is what we call a risky exit, and so people who would, again, on that straddle, that closest expiration straddle, will be willing to go to an even bigger loss, so even a 60% here. And so this is basically, again, using our calibration from before, but now going into even worse scenarios where here we notice that these 60% returns basically will occur over the next days if there is no stock move. So another approach to exiting would be, okay, I'm happy with this position, and I'm actually even willing to go to a higher risk this 60% as that we see, or 50% that we see over the next days. And so I'm willing to basically hold through more days after the release, since I'm comfortable going with that big risk anyway. Keep in mind, again, if we are such a person, it makes more sense to go with a strangle, actually, rather than using the straddle for this. But again, if one is comfortable with that position to go to a higher risk, Morgan Stanley was a case where that risk actually paid, because over the next day, the move of the second trading day after release, now the stock reached 6%, and so we actually hit an even higher target, around 30% return. And so the fact that we were willing to risk through the full first day and even go to that max risk of 60% ended up paying. The most important thing is being comfortable with these numbers before going into the trade, and so not having to react emotionally. We either have decided to be either a normal scenario or a conservative one, but these things can basically be automated, and we do not nearly have to monitor them manually, basically, as we can apply these strategies in really an agnostic way. Thank you for watching. I hope this was helpful. Let me know if you have any questions or remarks in the comments, and see you in the next video.